Stop believing bedtime stories about money. Stop believing that silver prices move in a clean and honest way based on simple buying and selling. And most of all, stop believing that the United States financial system plays fair with regular people. What you're about to hear is not a theory, and it is not speculation. This is proof that the game is controlled, the table is tilted, and the House already knows the outcome. For the first time, the people running the system have been caught with real evidence, not rumors. Today is Wednesday, February 4th, 2026, and this date matters. This is the day when the truth stopped hiding behind excuses and technical errors. This is the day when the illusion finally cracked in public view. The real headline should be everywhere right now. The price you see is not real. The market you trust is not honest. At Alex Carter Reports, we have received verified intelligence about a massive investor in the silver market. This is not a small trader clicking buttons from a phone. This is a powerful institution with over $100 million committed to one single mission. This investor has been quietly building positions while everyone else was distracted by headlines and noise. They were watching patterns that normal traders never see. They were collecting data that only serious money can afford to analyze. This investor is what the market calls a whale, not because of size alone, but because whales can move oceans. And this whale just surfaced with something explosive. They have delivered forensic-level proof that silver prices are being manipulated by bullion banks, not nudged, not influenced, but actively controlled by machines. The pricing systems themselves are fraudulent. Think back to last week for a moment. Remember when the CME suddenly went dark without warning? Remember when silver prices collapsed even though nothing changed in the real world? You were told it was a glitch. You were told it was a reporting error. You were told not to worry. That story was a lie. What actually happened was not an accident. It was a crime hidden behind technical language. This investor analyzed every single trade, millisecond by millisecond. They followed the trail the banks hoped no one would ever see. And what they uncovered explains how wealth has been quietly drained for years. The method has a name, and regulators already know it well. It is called spoofing and front-running. And once you understand it, you will never see markets the same way again. Here's how it works in plain English. You place an order to buy silver, thinking you're entering a fair market. But the bank's computer sees your order before the market does. In that tiny slice of time, measured in milliseconds, the system steps in front of you. The bank buys the silver first, at a slightly lower price. Then it sells that same silver back to you at a higher price. You barely notice the difference. It looks like normal market movement. But this happens millions of times every single day. Those pennies add up. They are pulled from retirement accounts, savings, and long-term investments. They are redirected straight into executive bonuses and trading desks, and that is only the polite version of the theft. The uglier side is called spoofing. This is where manipulation turns aggressive and intentional. Spoofing works by creating fear on purpose. Banks place massive fake sell orders that flood the screen. The market sees thousands of contracts offered all at once and panics. Prices drop instantly. Real investors react emotionally. They sell their positions to avoid losses. But here's the trick that changes everything. The banks never plan to sell those contracts. They cancel the orders the moment the price drops. Nothing was real. The fear was fake. The selling pressure never existed. It is like shouting danger in a crowded room just to steal wallets while people run. By the time anyone realizes what happened, the damage is done, and the manipulators walk away untouched. For years, voices warned about this behavior. They were mocked, dismissed, and labeled extremists. They were told markets are too regulated for cheating. Now the truth is leaking out quietly. Regulators are discussing settlements behind closed doors. Billion-dollar fines are being negotiated. But here is the insult hidden inside those fines. If banks stole $10 billion and pay $1 billion back, that is not punishment. That is a business expense. It is permission disguised as enforcement. It tells the banks the system will protect them. And it tells regular investors they never mattered. But something has changed. This time, the manipulation went too far. The machines broke something real. You can suppress paper prices forever. You cannot suppress physics. You cannot fake metal into existence. Prices were pushed so low for so long that mines began to shut down. Refineries slowed and then stalled. Supply chains weakened until they snapped. The rig worked too well, and now even the people who built it are scared, because the metal is disappearing. While the banks play games with numbers on screens in New York and London, something very different is happening in the real world. Far away from trading floors and flashing charts, the physical supply of silver is quietly drying up. And the first place where this breakdown became impossible to ignore is Switzerland. Switzerland is not just another country in the metals market. It is the center of gravity for global gold and silver refining. If metal exists anywhere on Earth, it normally passes through Swiss vaults. This is where the world's wealth is cleaned, measured, stamped, and stored for generations. Billionaires, governments, and central banks trust Switzerland for one reason. It has never failed to deliver physical metal when demanded. That reputation is now in serious danger. At Alex Carter Reports, we received confirmation that shook the entire foundation of the market. A senior executive from one of Switzerland's largest physical bullion dealers came forward. This is not a rumor or secondhand chatter. This is someone with direct access to inventory, shipments, and refinery flows. And his message was short, blunt, and terrifying. They have zero silver available, not low inventory, not delayed shipments. Zero. No bars waiting in vaults, no large deliveries scheduled. For weeks, they have been unable to source meaningful amounts of physical silver. Refineries are operating on leftovers. Wholesalers have nothing to offer. The banks that are supposed to supply the market have gone silent. Calls to London lead nowhere. Requests to New York come back unanswered. The system that feeds Europe's silver demand is empty, and this is where reality collides with the screen price. Because at the same time, price tickers still flash $86. The computer says silver is cheap and available. The physical market says it does not exist at any price. This is the disconnect that exposes the lie. The paper market claims abundance. The real world screams scarcity. Both cannot be true at the same time. This contradiction proves something important. The recent price crash was not a natural correction. It was a desperate attempt to force metal back into the system. Banks smashed the price, hoping investors would panic and sell their bars. They believed fear would unlock hidden supply. Instead, the opposite happened. No one sold. The Swiss did not sell. Long-term investors did not sell. Lower prices acted like a clearance sign on an empty store. Demand surged instantly, but there was nothing left to buy. Every ounce that appeared was snapped up immediately. This accelerated the drain even faster. The strategy backfired completely. Now consider what this means for Europe. If Switzerland is dry, the continent has a problem. Germany, France, and Italy depend on Swiss refineries for industrial silver. Automakers, aerospace firms, and electronics manufacturers rely on this supply. Volkswagen, Siemens, Airbus all need physical silver, not contracts. And contracts cannot power factories. Production lines cannot run on promises. Solar panels cannot be built with spreadsheets. Microchips need atoms, not algorithms. The realization is spreading fast. Paper wealth does not replace physical material. And Europe's strategic buffer has vanished. So where did the metal go? It did not disappear. It moved into stronger hands. It flowed toward buyers who saw this coming. It moved toward entities that no longer trust paper markets. And it began concentrating in one place, the United States. While Swiss vaults sit empty, American vaults are under siege. The pressure has shifted across the Atlantic. And what is happening in New York is unprecedented. The warning signal is something called the Zero Stock Report. It is the canary in the coal mine. It tells us the system is seizing up. The engine is overheating while the dashboard still shows green. And that engine is the COMEX. To understand how serious this situation has become, we need to slow down and look at the raw data coming out of New York. Not opinions, not speculation, but hard numbers that show stress inside the system. And what those numbers reveal is something the market has never seen before. February is supposed to be quiet. In the silver futures world, it is considered a non-delivery month. That means almost nobody asks for physical metal during this period. The active delivery months are usually March, May, July, September, and December. February is normally empty. Volume is low, activity is slow, and warehouses expect calm. Traders typically roll contracts forward or walk away. Delivery notices are often close to zero. It is the market's off-season. But this February, the rules were ignored. In just the first 4 days of the month, something shocking happened. The COMEX issued 2,955 delivery notices. That number alone should stop you cold. In a non-delivery month, it is almost unheard of. It signals stress, urgency, and fear. Each silver contract represents 5,000 ounces. When you multiply that by 2,955, the scale becomes clear. 14.7 million ounces were demanded for immediate delivery. This happened in just 4 days, during a month when delivery is not supposed to happen. This is not normal behavior. This is a run on the vault. It is the financial version of people lining up at a bank demanding cash. And the system is not built for this. Warehouses are not staffed for sudden surges. Transport contracts are scheduled months in advance. Logistics move slowly, not at panic speed. But here's where the story becomes even more disturbing. At the end of January, open interest in February contracts was tiny. Only 1,831 contracts were still active. The logic says you cannot deliver more contracts than exist. If every single holder demanded delivery, the maximum should be 1,231. But the actual number was 2,255. That means more than 1,700 contracts appeared out of nowhere. That represents over 8 million ounces of silver. And it did not come from existing positions. This demand came from new money entering the market. These buyers showed up on February 1st, 2nd, and 3rd. They were not there to trade. They were there to take metal. They bought contracts and immediately exercised them. Some did it within minutes. This behavior is extremely rare. It ignores tradition, cost, and convenience. It signals urgency above all else. The futures market was used like a grocery store. They walked in, cleared the shelves, and left with the goods. No waiting, no speculation. This is what fear looks like when it wears a suit. These buyers did not care about premiums. They only cared about possession. They knew something most people still do not. They knew Switzerland was empty. They knew London was drained. They also knew this might be the last place on earth to get silver at the paper price. So they acted fast. And they acted in size. The drain rate is staggering. About 3.5 million ounces per day. At that speed, registered inventory disappears quickly. This 14 million ounce pull proves something critical. The price smash failed. It did not scare supply loose. Instead, it attracted predators. It signaled weakness. And sharks do not ignore blood in the water. These buyers are not small players. They are not retail investors. They are something else entirely. They are what we call the new longs. And they are the most dangerous threat the bullion banks have ever faced. The new longs do not play by old rules. They do not care about charts or sentiment. They care about survival and control. This kind of buying suggests deep pockets. It suggests logistics planning. It suggests a long-term strategy. Possibilities include sovereign wealth funds, large industrial users securing supply, or coordinated pools of ultra-wealthy capital. Whoever they are, their message is clear. They do not trust the system, and they are done waiting. The moment the new longs began demanding metal, panic quietly spread through the banking system. This was not public chaos with flashing headlines and alarms. This was private panic inside offices where risk models were supposed to prevent exactly this. Banks are comfortable when traders speculate. They are comfortable when contracts are rolled forward. They are not comfortable when buyers demand delivery, because delivery forces truth. It forces vault doors to open, and it forces inventory to be proven, not promised. When a stop notice is filed, the bank must act immediately. Specific bars must be located. Serial numbers must be verified. Those bars must be loaded, transported, and handed over. No delays, no excuses. But here is the problem shaking the system. Much of the registered inventory is not truly owned. It is leased, rehypothecated, or promised multiple times. If one party demands delivery, someone else comes up short. So banks begin scrambling behind the scenes. They borrow from one desk to cover another. This is where internal chaos begins, and this is where emergency tools appear. One of those tools is called EFRP, Exchange for Physical. It sounds harmless, but it is not. EFRP allows banks to offer cash incentives to avoid delivery. Here is your premium. Just do not ask for metal. In calm markets, this works. Traders take the money. The system survives another day, but the new longs are refusing. They do not want cash. They want silver. That refusal terrifies the cartel, because it means someone is testing the system's limits, and limits reveal cracks. The new longs are not chasing profit. They are chasing control. They are removing metal from circulation. This is a strategic move, not a trade. It is designed to expose shortages, and it is working. The music is slowing, the chairs are disappearing, and the banks are standing. When the music stops, there will not be enough chairs, and those without metal will be exposed publicly. This raid has not gone unnoticed. The United States government is watching closely. They see the same data the banks see. They see Switzerland empty. They see COMEX inventories falling fast, and they understand what this means. Silver is not just an investment. It is a strategic material. It powers technology, defense, and energy. If the supply drains freely, the economy becomes vulnerable. So the government decided to intervene, and they moved faster than anyone expected. At the Critical Minerals Summit in Washington, something historic happened. Vice President J.D. Vance took the stage, and his words changed the market forever. He announced the formation of a critical minerals trading bloc. Over 50 nations are joining forces, including Canada, Australia, Mexico, and the European Union. This is not symbolic. It is structural. It is strategic. But the real shock was not the alliance. It was the policy behind it. Two words froze trading desks worldwide: price floors. The U.S. government openly stated it will set minimum prices for critical metals. Silver is on that list. So are cobalt and rare earths. This ends the free market experiment. Prices will no longer fall below production cost. Paper games are no longer allowed to starve supply. If banks smash prices down, the government steps in as buyer. If prices fall to 80, they buy at 100. This is a floor backed by unlimited funding. The reason is simple. Low prices helped China accumulate stockpiles. They hurt Western miners and manufacturers. Every smash was a subsidy to Beijing. And Washington finally noticed. National security now outranks banking profits. And that changes everything. Now we arrive at the conclusion. And this is where everything comes together. What you're witnessing is not a temporary spike or a dramatic news cycle. It is the official end of the old silver market. For decades, the system was designed to push prices down. Low metal prices made paper money look strong. They kept inflation hidden and confidence high. But that strategy reached its breaking point. It emptied vaults. It starved mines. And it handed strategic resources to foreign rivals. The United States government finally acknowledged this reality. By announcing price floors, they admitted the free market failed. Silver is no longer treated as a toy for traders. It is now classified as a strategic asset. That means it will be protected. And protected assets do not collapse in price. Think about what this means for investors. For the first time, the downside risk has been removed by policy. If prices fall, the government buys. That is a standing order backed by the printing press. Banks cannot fight it. Algorithms cannot override it. This alone ends the manipulation era. Spoofing becomes irrelevant when demand is infinite. Shorting becomes suicide. If a bank tries to force silver lower, it supplies the government. That is a losing trade. And the banks know it. This is why the smash is over, the floor is in place, and the only direction left is up. Combine that with empty Swiss vaults. Combine it with the new longs draining COMEX. Combine it with industrial demand that cannot pause. This is not a squeeze driven by hype. It is driven by physics. And physics always wins. Now think about timing. Right now, paper prices still reflect the old system. Algorithms are still running yesterday's playbook. But underneath, a new structure is forming. Government buyers are preparing. Supply chains are being rerouted. This creates a rare moment, a gap between fake price and future reality. An opportunity that does not last long. You cannot buy cheaper than the government. Once the floor is officially enforced, the window closes. There will be no return to $86 silver. Waiting for confirmation is waiting too long. By then, premiums explode. Inventory disappears. The new longs understood this. That is why they pulled 14 million ounces in 4 days. They did not hesitate. The Swiss understood this. That is why they stopped selling. They are protecting what remains. And now you understand it too. At Alex Carter Reports, the verdict is clear. The silver market was broken, then exposed, and now replaced. The free market era is over. We have entered the age of strategic scarcity. Metal moves toward power, not speculation. And governments are now the biggest players. This is not financial advice. It is a reality check. The system has changed. The whale has entered the trade. The floor is set. And the squeeze now has government backing. Do not bet against the entity with unlimited funding. Do not trust prices designed by yesterday's rules. Understand the shift before it becomes obvious. The smash is finished. The rig is flipped. And the countdown has begun. This is Alex Carter Reports. The era of cheap silver is over. Position accordingly.